The following is a presentation of TFNN. The Tiger Technician Hour with your host, Basil Chapman. Call now, toll free at 1-877-927-6648. Internationally at 727-445-1044. Now, Basil Chapman.
Hi everyone, Basil Chapman, Tiger Technicians Hour on this last day of October. What a month it's been. That's outstanding action. Not everywhere, but the indices certainly have done very well. And thanks to our guest hosts from earlier on, and of course, all the way through, we got Nico and Paige straight after this. Then you've got Steve Rhodes, Dave White, Tom O'Brien, and then Tom interviews Dave White. So just great program all the way through. And of course, for my subscribers, I just want to remind you that over the weekend, I will be sending out a lot of charts, and I will also try to put together a plan that involves the action that I perceive should happen over the period of November, December. The other thing is that this is a very important moment for a number of reasons, because my contention has been for years and years that when the markets, especially the Dow, survives an September-October sell-off and acts extremely well in the month of October, there's just a real good chance that it's going to try at least to close that year close to the highs of the year. That's just been the tradition in my way of thinking. So we're looking here at the Dow 10-minute, the E-mini 10-minute December contract, futures contract. The 2077.25 left side, right side price time match was met within, it's within 3 bars, going from the low of 210, 10 past 2 Eastern time on the 29th, where it was at the low was 207.725. Excuse me. The second buy mode was confirmed, and it continued higher, and then went to a third buy mode to a peak E, 10-minute chart, double top at 2,094.75 at 1 o'clock, and then 110 yesterday. No, how can that be? Oh, this morning. No, 110 this morning. Sorry, I got confused there. And then on the way down, it went trough A, B, C, D, E, alternate count E/A, alternate count F/B, alternate count G/C. The way it's looking, I'm inclined to immediately just grab my arch formation tool and say, that's the pattern we're going to be looking at if, in fact, the low of 2079 is taken, 2079.25 is taken out, then there should be a retest of the low that we just saw of 2077.50. If that gets taken out, we can go even lower and then retest the low of the 29th at 11 o'clock when my show started yesterday at 207.5.50. And we go step by step. Now, this is very important. Because it's held this key level, if there is a rally, and that rally takes the E-minis to 2083.50, all of a sudden you're looking at a mini V-shaped formation, and that says how it can hold over a period of 3 10-minute bars above 2085 would be very important, because if it holds well, there's a chance it could pop up. This is what I said to subscribers this morning in my opening call. I said at noon, if the Dow is up 30, that would be fairly positive. If the Dow is down 20 to 30, that would suggest that we're in a trading range and we're going to see a mixed close. And I'm suspecting we're really looking more at a mixed close here. So let's go back to the stories and we'll just run the numbers. The Dow is up, the Dow is now down $1.70 at 17,754. The S&P is down 173 at 2,087. The comp index is about unchanged at 5,073. Gold took a hit earlier on, but now it's only down 5 at 1142.30. S&P is down, the silver is down 0.01 at 1553. Platinum's down, copper's down, crude oil's down. Bonds are up 10.30 seconds. Now, that was quite a hit that was taken yesterday. I need to talk about that a little bit more. I'm also going to go to the XLF, the financial ETF. I'll look at those. But first, we want to take our caller, Mark in Fort Collins. Mark, how are you?
Good, Basil. How are you?
I'm well, thank you. You're looking at?
So this is an interesting thing I'm thinking of because I'm just trying to figure out when this market's going to top out. And I'm looking at the IWMs, and to me it looks like it's made the body, or already made the body of a stork leg. And it hasn't gotten to a D, it's gotten to a C, unless I'm counting wrong, from the lows of 929. And I'm wondering if we're just going to, and it's also potentially got an ABC up going on a daily because of the big candle it had on.
You mean towards the 118s?
Yeah, actually, if you do an ABC up from.
Then it goes further. Yeah, it goes towards 120.
Like the 121, which is kind of would be in line with what the other indices are doing as far as testing higher levels. The IWM has been lagging, and it's been interesting, but now it looks like it wants to catch up. So I was wondering what you think about that.
Okay, and at this position right now that we're looking at, you don't have the IWM either long or short. You're just looking, and this is an analysis because you're doing other things, or do you actually have a position?
Yeah, well, I've got, I've been kind of short, and I'm a little nervous about being short because it looks like the market's not done. And I'm thinking of closing some shorts and waiting till this IWM completes, and then maybe looking at shorts. But I don't know. What's your thought?
Okay, so you've actually dealt on a whole bunch of things just with that one statement about the IWM, and then you mentioned the stork leg formation, which it's funny. I looked at it. I thought, should I put it in? Because the stork leg formation invariably is higher. It's after a move has been made, not coming off the bottom. Normally, when I see something like this, the first thing I would do, and you've seen it many times, is I grab my arch formation and I draw in an arch or a lowercase h, and that would be saying the upside is limited, but if the downside starts to break, you're going to come back down further. And the weekly chart has made an H and gone to a lower low from 108.26 back in the week of the 27th of August to the week of the 2nd of October at 106.99. Then it had a fabulous move in percentage terms, but nothing like the Dow or the S&P, or certainly not like the Qs, or even General Electric if you just want to take one stock. So my impression here is I'm going to put this in because I think it's a really good observation, and you've done a nice analysis. So I'm going to put body right here. I'm typing it in. That's the body. And basically, it's kind of made a little bit of a neck right now. So it's not fully a conventional stork leg formation, meaning that there's a strong series of moves up that is like a straight line move that stops there. Usually it stops there at about a C or maybe even a D, and then it goes sideways, making a definitive oval. It's not a rectangle pattern, but it looks like an oval. This one looks like an oval. The only difference is that because the low 3-4 days ago was above the previous low, that's perfect. But the high that was just made, the characterization says that that high that we got as peak C should have been a little bit earlier. But what's really important is that you've got the oval. The reason why I talk about an oval pattern in the Chapman wave stork leg formation is you want the body of the stork not to be an oval, but really, no, not to be a circle, but an oval, and you've got that. So here's what I'm looking at. Everything, all the analysis that I've done over the past few days is saying that the move that we've seen in the larger context is extremely positive and has been right up until now. At this particular point, I can show you a bunch of things that will show you that we're bumping into an area that should be, and so far looks like it has been the last couple of days, strong resistance. However, I think that you're right that there is a possibility of one little sudden pop to the upside over the next 2 days as money comes in for the November mutual funds. So maybe we've got 2 days, a little bit more of an extended move to the upside. But almost every chart pattern that I'm looking at is suggesting that we're in a leg D, E, or even an F, and I'll run through those in a moment. But what I think I'm going to suggest to you is that As far as the IWM is concerned, let me just grab the 120-minute chart is right here. See, the 120-minute chart has gone peak A, B, C, and it's just made a D and an E in that same pattern that I call the camel hump, where you get the stochastic to rally up, then pull back, and then looks like the move is done, and then suddenly there's one extra move to the upside. So I can give you very specific parameters to watch, which I think will help you just in terms of looking at what might be an area, if you are short, to start looking to either cover or just to watch closely. And here we go. The high today in the IWM has been, is that today? Yep. No, that's on the 28th. On the 28th, the high was 117.14. We're at 115.59. If there is a move between today, I don't think it'll be today, but if it's today and maybe a gap up on Monday or something like that, that takes the IWM to the 116.50 to 116 area, and it doesn't pop and drop, but it goes there and it just sticks. The market does not pull back after that. In fact, it starts to hold. Then there could be further buying to take it to leg D. I don't think this is going to be a one-to-one, that propeller shaft extension that I often talk about. This is more like the leg, the body, and a short neck, and the 200-period exponential moving average in the IWM is at 118.40. So I'm going to make it real simple. A pop into the 116.50, 116.60 area says, hey, you've got to be a little careful now. You could get that D, but you want to be looking at the VIX index, and the VIX index, if it's not moving down much, and if the Dow and the S&P are not moving comparably in percentage terms, I would say to you, you can stay in that position right now. If you start to see it stick and it takes out the high at 117.14, it goes to 117.15, and the general market's moving higher, I would say lighten up on the short position. You can quite easily put it right back on. But the reason why you want to be a little careful is that you've got 118.40 as that 200-period moving average. And the closer you get to it, the closer it becomes a magnet. So that's my recommendation. I don't actually think it's going to happen right now, but maybe Monday we get one more pop to the upside. That's what I'd be a little nervous of now. Will it stick? Okay. Will the IWM making leg B right now in the weekly chart, in fact, be saying to us, don't look at that pattern. You're looking at an arch formation. And in fact, regardless of whether it pops up or not, it's going back down to test the low of 113.10. That's kind of what you really would like to see. Yep. That arch formation will not take place if it starts to hold and the VIX index drops even further, even though it's not directly related to the IWM. If it drops further and the general market's moving high, then you've got to be careful. But if it does that and it's starting to move higher, that weekly chart starts to trigger in and say, hey, don't ignore me. I'm trying to play catch up here. Those are the parameters.
All right. Thank you.
Okay. I hope it helps you. Thank you, Mark. Good question. And that stalk leg, I'm still going to keep it in here. There it goes right back.
Okay, bye.
Folks, Basil Chapman, we'll be right back. Dow's down 18, S&P's down 3.5. And we're going to be talking about the financials and some other things as soon as we get back.
If you're looking for a great opportunity to diversify your financial portfolio and hedge against the falling stock market, consider the new market-safe Metals Hedge CD from Everbank. This 5-year indexed U.S. dollar-denominated CD gives you exposure to metals with gold and silver components and allows you to hedge against falling equities with a short component on the SPY ETF. You can earn up to 45% capped upside payment at maturity if gold and silver increase in value and the SPY ETF decreases across annual pricing dates. And should the opposite occur, your principal is 100% protected. Keep in mind, returns are based on CD performance. There is no annual percentage yield or periodic rate of interest on the CD. Don't let falling markets get you down. Get the Metals Hedge CD. The November 12th funding deadline is quickly approaching, so hurry over to everbank.com/TFNN for the CD's term sheet and other important product details and disclosures. Once again, that's everbank.com/TFNN. This is sponsored content. Everbank is a member FDIC.
Since 1984, Basil Chapman has been using the Chapman Wave methodology to advise traders of his expert market opinion. While originally hand-drawing charts from the late 1970s into the 1980s, Basil noticed that prices under most circumstances virtually always had a certain number of legs to the upside before declining sharply. Later, Basil found that computer software, which included the standard market technical indicators, enhanced the degree of accuracy in calling price turns as well as market trend calls. Thus was born the Chapman Wave sequence. Using the Chapman Wave methodology along with other indicators, Basil Chapman advises his subscribers of his expert market opinion each market day with his opening call newsletter. Right now, you can get a 2-week free trial to the opening call, Basil's daily trading newsletter, by visiting the front page of TFNN.com. Cancel at any time during that trial and pay absolutely nothing. Get your 2-week free trial to Basil's newsletter, The Opening Call, today by visiting TFNN.com.
Many of our new listeners have heard about the Tiger's Den, but wondered, what exactly is it? The Tiger's Den is a lively community where professional traders and investors can meet, exchange ideas and information in a comfortable, moderated atmosphere. Hear all of your favorite TFNN shows, plus see all the charts as they happen live during those shows, and have access to all those charts. You can test drive the Tiger's Den absolutely free for 30 days. It will greatly enrich your knowledge of these markets. Details on the Tiger's Den are on the front page of TFNN.com.
The Path of Least Resistance is David White's daily trading newsletter, and if you're looking for active trading ideas, then now's a perfect time for a 30-day free trial to this powerful daily trading advisory service. David uses his years of trading experience to offer his subscribers his trading ideas each morning in his Path of Least Resistance newsletter. Using a combination of equity trades along with options, David keeps his subscribers up to date with all pertinent market information with intraday afternoon updates when warranted. Don't miss out on this great chance to get a 30-day free trial to David's daily newsletter, The Path of Least Resistance, with no obligation to pay anything. David has been delivering solid recommendations for his subscribers recently, and if you'd like to see the type of newsletter he delivers every morning, then visit the front page of TFNN and you'll find the Path of Least Resistance under Trading Newsletters. For all the details and to start your 30-day free trial today, log on to TFNN.com now.
Tiger TV is an exciting way to experience TFNN programming. See high-definition video, giving you crystal clear charts, as well as seeing some of the faces of TFNN's highly acclaimed financial experts with crisp, full-fidelity sound. Catch Tom O'Brien, John Logan, Steve Rhodes, Basil Chapman, Larry Pesavento, Think or Swim, David White, Andy Hecht, and Daryl Martin in crystal clear, high-definition audio and video. Tiger TV, exclusively at TFNN.com. Basil takes your phone calls now. Toll free at 1-877-927-6648. Internationally at 727-445-1044.
Hi, folks, we're back. So I had a couple of questions. I'm going to get to the XLF, but let me first say that the IYR, that is iShares Dow Jones U.S. Real Estate Index, is mostly the commercial real estate. In fact, pretty much all the commercial real estate. And real estate of areas you would not expect, for instance, AMT, which is the towers, American Tower. So you've got Tower. Then you've got PSA. I mean, that is basically a storage company. So it's a real mix, but I think it's actually a pretty good mix. And, VNO, SPG, just goes all over the show. So it's acting quite well. But it's made a peak D with a round number, 77 high, back on the 23rd of October. It's suggested by the candle of 3 days ago that it's got a boundary. If it closes above 76.36, probably going to retest the high that was just made. And if it closes below the low of that, the 28th of 74.65, over the next just less than a point down, then there's a good chance over the coming week that it will be going lower. My eye says that there's a little digestive phase that should be coming up. The real test will be between 73.5 and 72.5. That's kind of what I'm looking at. So as I see it, I want to just treat it as a wait and see. It's completed its move to the upside, just breaking the 76.69 last high of August. It's gone all the way down to 68s. Let's see what happens here. Now, let me just tell my subscribers, in the position that we were going to add on the short side this morning, the price that I put in, for some reason I blipped out the -1 stop So it says minus 0.00. Obviously, that's not exactly good. I did send out, as I always do, if there's any error, by 9:30, I sent out a correction, and that's what you always have to look for if something looks a little weird. So it'll be -1 if we do get it, -1 as a buy stop. Just wanted to clarify that for my opening call subscribers. And yes, I am looking at longs and shorts. That's what we have. I don't see how I can't be mixing it up here. I do see stuff that is long positions that are acting really well, and I do see stuff that are short positions, and I have to go there. So it's a mixed portfolio. But the indices themselves, the next major correction to the downside, I believe that I'll be looking to be buying as much as I can in the way of the indices, just based on what I've seen. Whether or not we go short next week is another thing. That might be just for short-term traders. We'll see. So now I want to go to quickly Facebook. Look, Facebook's made a leg D. It's got a peak D in place right now. This is the reason why I'm a little cautious going into next week, and I think it's peak E on the 120-minute chart. Amazon, look at this. We spoke about it yesterday. Amazon gapped up and it continued high. That's really good action, but it is leg E as I'm measuring it right now in the Chapman wave. E daily, E weekly, D monthly, and I didn't do this. I'll do it right now. That's A, B, C, D, E. E in the 120-minute chart, I believe. So got to be a little careful. Next thing is Google. Let's go to GOOG. I'm just going to go to the extra GOOG stuff. Yeah, this has got that Chapman wave gap up, news related. Was it last Friday? Yep, last Friday. Look, it hasn't broken above the 730. Oh, typed that in, and then I lost it. 730 all-time high, round number, all-time high. So I really do have to watch this closely. Leg E in the weekly chart, leg G/C monthly chart still looks really good. So watching Google very closely. Facebook, Amazon. Did I do Amazon? I just did Amazon. Amazon, Facebook, Google. Did I do Amazon? Did I do something? Yeah, of course, I just did Amazon. So let's look at price line. And here's price line. Leg G/C, good move, gap up today at 1,450. Remember, I spoke about that 1395. We're expecting a leg D in the weekly. You're still in leg D. Amazing move. One of the really good monthly charts on price line. D in the weekly, D in the monthly, G/C in the daily. So this is all saying be a little careful here. We could be getting a turnaround after fund buying on Monday or so. Now let's go to the bank. Look at the XLF. The XLF at this particular point. Leg D, that's the way I'm calling it at this particular point. I could give it alternate counts, but I'm calling it D, making a potential peak E with a little doji high yesterday at 24.55. Let me type that in. 24.55. No great, this action is good. It's not fantastic. So it's up 10%. And basically what we're looking at, did I say 55? I think I did. Let me just type in a 5 there again. Now let me check. Yeah, 24.55. Weekly chart, after that incredible candle going down to 18.52. This is 6 points. I mean, 6 points in the XLF in just a couple of months. So what we're looking at here is leg B with a potential doji candle. And so just be a little bit careful here. And I'm going to run and a peak F in the 120-minute chart. Monthly has improved a great deal. I'll run through the different components of the XLF, the financials, the S&P financials when I get back. Dow's down 11.
Platinum, grains, crude oil, gold, copper, cattle, hogs, gasoline, natural gas, coffee, cotton, cocoa, and sugar. These are just some of the commodities mentioned in the most recent issue of Andy Hecht's Technomental Commodity Report. Andy publishes his weekly newsletter every Thursday morning, where he breaks down the commodity market and provides his subscribers with specific trading recommendations based on his trading methodology. By signing up for a free trial to the Technomental Commodity Report, you'll get a full 30 days to try out this powerful newsletter service and see for yourself the types of trades Andy has recommended for his subscribers. When you sign up for a 30-day free trial, you're under no obligation to pay anything. And should you decide to continue, you will lock in the low rate of only $79 a month. Sign up right now for the Technomental Commodity Report and make sure you're ready to catch the next big trade in commodities. For more information and to get started today, visit the front page of TFNN.com.
TFNN is excited to offer a brand new piece of market scanning software unlike anything the industry has ever seen. John Logan and his team have spent years developing their market profile tools to finally be able to release the TAS Profile Scanner Plus. And right now, you can get a 2-week trial absolutely free just by visiting TFNN.com and providing us your name and email address. The TAS Profile Scanner Plus is the premier market profile-based scanner in the industry. By the acclaimed TAS proprietary algorithms, this feature-rich scanner is a standalone desktop software that instantly filters over 2,500 global financial markets such as stocks, ETFs, commodity futures, and Forex. Within 3 minutes of signing up, you can have the software downloaded and running on your computer with a complete roadmap of market indicators and inflection points to trade off using the TAS Profile Scanner Plus. Sign up today and try this amazing piece of software by visiting TFNN.com. Larry Pesavento has just started his brand new service, Fibonacci 24/7, and he's already delivering content to his subscribers on a daily basis when the market's opened and even on weekends. Each Monday, you'll receive Larry's written report that provides detailed commentary and a summary on the charts and videos that Larry sends out. And throughout the week, when warranted, Larry will send out via charts or videos or both the key markets that he is watching during the day. This will be up-to-the-date, active trading information that will help you in your daily trading. In Larry's first week alone, he sent out 25 charts, 6 videos, and a full report to his subscribers in just 1 week. If you're a technical trader that uses patterns and retracements to trade, then Larry's service Fibonacci 24/7 is something that you must try. Right now, new subscribers can get a full 30-day money-back guarantee. With nothing to risk, sign up now to Larry Pesavento's Fibonacci 24/7 by visiting the front page of TFNN.com under Trading Newsletters.
If you're an active trader looking for that extra edge when it comes to trading and investments, then now is a great time to get a 2-week free trial to Tom O'Brien's daily market letter, Market Insights. Tom O'Brien's daily newsletter, Market Insights, comes out every market day at around 9:30 a.m. and provides Tom's daily commentary on the broad market, including the Dow, NASDAQ, and S&P, plus specific trade recommendations. There's even an update published most afternoons to keep you informed about the day's market activity. He'll give you the entry price, price target, and stop price of each stock and option trade. With Market Insights, there's nothing left to guessing. For all the details and to get your 2-week free trial to Market Insights started today, visit TFNN.com.
This segment is brought to you by Think or Swim. For more information, just click the Think or Swim banner on the front page of TFNN.com.
Folks, as we get back, I just completely forgot as the show was closing yesterday, I had a couple of questions. I promised I'd get to it today. And the one question was, well, let me just show you. LinkedIn just gapped up on a Friday to a leg E, up 11% to 241.93. The all-time high is 276.18. This is looking really good. And this is one of the reasons why the rotation is confusing, because if you're looking, say, at Panera or you're looking at Buffalo Wild Wings, you're seeing the exact opposite picture. One is saying perhaps the economy is slowing down. All of a sudden, LinkedIn, a business, this is really part of the business scenario, has a really good trend. And look at the weekly chart has improved. So now let me just go back to something that we've looked at a long time ago. I don't actually follow it all that much, but the question was Nike, and I'm getting back to the XLF in a minute. Nike is trading at 130.26. It's only down 86 cents. The high was 133.52. It had a Chapman wave 2-bar reversal. It went from 133.52, and the very next day the high was 133.36. But then it went sideways, 1, 2, 3, 4, basically 4 highs. But the lows kept getting lower and lower. So the question is, I can't remember if I was short, what should I look at, or if I'm going to short, I just can't remember now. But my contention was, I believe I sent back a quick email saying I'd be looking at 130 to 129 because a close, 129 to 128, because a close below that immediately says that the technicals are correct in breaking down and that the price should be following. So I'm looking at this and I'm saying, the sideways move always makes me a little unsure, because sometimes you're looking at time and you get impatient, and eventually it does what it does, but it doesn't break the high, but it really just wears you out by not going anywhere. So my suggestion is, if you're already short the Nike, all you need to do is at 130.25. I don't think it's a big deal to make 133.53, 1 penny higher, although technically it should be like 134.50, because if it's going to just double top again, it's easy to make it by 1 penny. So let's be reasonable. Let's make it from here 130.27. Let's make it a 5-point stop, buy stop, that is. So if it closes at 100, if it hits, doesn't have to close, 135.27, if it was right now, you'd be out. So 5 points on $130 stock for maybe the first time you're attempting a short position. You know, sometimes it takes 1 or 2 tries if you're using technical analysis to get it exactly right. And when you're right, it should more than make up the losses. That's the way you want to look at it. So I'm looking at this and I'm saying, okay, you can start here. If you want to, a small position, you could even have a half position and then add to it if it breaks 128, and then put a stop at the entry points today, so that one makes a break-even trade and the other loses you 2 points or whatever it is. So, okay, I hope I covered that. And the 120-minute chart is suggesting that the low that was made just at 128.91, that's really like a magnet at this particular point. Okay, so now we're going back to the XLF. So the XLF we were looking at, and we were saying the monthly chart is looking much better, because for the month of August, it was just, can you imagine closing down in the 19s area? And here we are at 24.19 above the 9-period exponential moving average. Last month, we couldn't even break that, and now we're above it and closing above it. Well, it looks like we're close above it. And that level is at about, give or take a few cents, 23.94. And here we are at 24.20. So that's good. But on a very short-term basis, the 120-minute chart, PKF, it just looks to me like some digestive pullback is necessary. And it doesn't have to be deep, but let's just say the 23s is the area I'd be looking at. 23.40, first real support, breaks that, the 23 to 22.90 area. Closes under this low right here of the 14th, under 22.86, all of a sudden I'd be saying, uh-oh, it's going to be a little bit deeper and a little bit longer, more sideways action. So we'll watch this closely. To buy it now, if you want to start the tiniest position just to be in case we suddenly flurry up on next week, that's the only way I'd do it. It would be the starter of a position that you really want to be looking at buying lower down, not here. That's just my impression right now. I do believe we're in a correct. We're starting another like the first few days of this week. In fact, that aberrational spike after the Fed, I'm wondering if that was not a kind of a give up on people who had been short or not been in the market and said, I'm going in, I'm done. So I'm watching this real closely. I still believe bifurcated markets need a bifurcated concept. You can short stocks that look weak, or making highs that are just about to maybe turn and experiment to see if you like a Nikkei. Okay, now we're going to go on. You got JP Morgan. JP Morgan is a peak C with this little doji. The MACD is still good, but a little stretched, but still very good. And stochastics at 91, so it's holding well. That'll change. And leg B in the weekly chart, monthly, it looks like the XLF. Monthly is very good, and the 120-minute chart is suggesting a pullback. I'd love to look at the 200-period of moving average of 63, say 30s. I'd like to look at it if we can get to between 63 and 62. Just someone send me an email, do something, because if I forget to look at it, that's where I want to look at it again to see, are we in the middle of a trading band? Do I want to be looking at it closer, lower down? Or is that going to be a base of support with rising highs and rising lows to get into JP Morgan? Bank of America, same thing. It's gone an even steeper. This is a leg D. Look at this beautiful rally that it's gone into. So that was the original low, and it went to a peak A, a B, a C, and then a D. And now we've just gone A, B, C. What's your objective in the Chapman wave? You want to get to a D, and then you're going to have to make decisions. But it's nice to have at least some kind of a template in which to be able to organize these things. So here we are, once again, a peak D. Is this going to be the same as the last one, a deeper correction? It's making higher highs and slightly higher lows. So this is going to be, from the deep low of the 24th to the low of, I think, September 29th, with a huge volume spike. So I'm looking at this and I think Bank of America, down 24 cents, BAC at 1685. 1662 to 1645 to 1629 are the three moving averages support that I'd be looking at. 9 period, 200 period, and then comes the I believe that should be the formatted 50. Yes, it's the 50. So this is the 50 right here. So that whole area, nice support. Weekly chart looked much better yesterday. Now it's pulled back. But I have to tell you that the monthly chart is the one that says trading range. But if Bank of America at any point on a weekly basis, not a monthly basis, closes under 1460, which is 2 points lower, that's a big move down. But it's a monthly chart. If it closes below that, watch out. But if it closes anywhere, if it tests the high that it just made 2 days ago, that's 1744, and then pops to 1760, Bank of America is saying, watch out, guys. We've started to correct ourselves, and we're forming a nice pattern. So let's go to Morgan Stanley. MS, have I got this updated? Morgan Stanley just missed making a leg D. Pattern is not quite so positive. So I'd be giving it a miss right now. It needs a lot more work for me to say that it's in the category. Goldman Sachs, so what happened? So Adam asks about Goldman Sachs, and he asked again about the XBD, which is the is that the Philadelphia Bank Index? I think so. So now what we're looking at is I'm looking at Goldman Sachs, and I'm saying leg D right at the 200-period moving average, got repelled yesterday and today, is at 188.68. GS is down at 121 and 188.68. I'm looking at this and I say, okay, started leg B. That's a good sign, but a lot more work needs to be done for me to be confident about the weekly chart. Monthly chart is bumping to the resistance we would expect at the 9-period moving average, at the trend line resistance. So Goldman Sachs is better than Morgan Stanley, but it's not as good as JP Morgan. And I do want now to go to Bank of America, because that's the one over the years that's just been such a stellar performer. Look at how steady it's been. Look at that. And who talks about now, of course, is Bank of America, Bank of New York, Mellon. So the conglomerations. I must talk about that. Within all the sectors of importance, and I would absolutely include the biotechs, the IBB biotechs, I think we're going to go into some kind of a consolidation thing where you get fewer and fewer stocks because there are takeovers. This is a period that I'm looking at as a potential takeover period, a period where, I've always talked about this, the auto industry back in 1920s, even here in Mass, I think there was something like 300 or 500 auto companies. They're amazing. And of course, things whittle down until you get 3. Whether it's banking, whether it's whatever it is, you eventually just get kind of like 3. And that's where you get the monopoly that comes on. It's almost like the international, multinational oils. So what we're looking at here is that I think there's going to be a chance that we have more consolidations going on in the bank industry, and we get a tremendous amount of consolidations, takeovers, joining parts of companies in the biotechs. Maybe with the farmers, maybe the pharmaceuticals are going to say, hey, we have no choice now. We're going to have to buy. Probably it's the other way around, that the biotechs are now so flush with money that they're going to be buying the old line pharmaceuticals. I don't know. I'm just saying that that's why shorting individual stocks in the something like the biotech sector is fantastic when it works. But now you're going to start to get that thing where you've got a fantastic short, and the next thing you know, overnight, boom, Elegant, I don't know, whatever it is a takeover target, and things spiked up 20%. That's where you got to be a little bit careful. It's unfortunate, but that's the way it is. So a question about whether I look at UA, I think I've done a lot with the banks. UA, I'm of the opinion that Under Armour might, in fact, be undergoing a hat-trick top formation. You got your leg D and the peak D in the weekly. We were waiting for that. You got a sudden move to the upside. It's a peak. Look, in the daily, it's gone A, B, C, D. Under Armour, UA is the symbol down $1.15 at 95.19. So how is this going to play out? How can we have another major move to the upside when the retail sector index, the retail sector itself, is starting to show so much weakness in so many stocks, and the restaurant industry, this is already part of the economy. Now, I think the restaurant industry I can talk to by saying, I believe competition is really the issue here. Here in Newton, Massachusetts, I don't know if I'm correct because I do remember the number distinctly, and it was shocked me. But I'm going to check it out. But I believe I read in the Newton tab, in the tab, the weekly local newspaper, that there were 178 restaurants in a city of 80,000 people. And I can tell you from experience looking at the prices and wanting to take some people out, at the more expensive places, the prices are not just more expensive, they are out of sight. And that the others have been bumping up prices, and I don't know how you can see the Paneras, etc. Their cost structure, things have changed dramatically, and I'm not sure how many restaurants can actually survive here. This just sounds like an outrageous number for a town of 80,000 people. So we'll see what happens. But I think that that Under Armour fits in that category with Nike that I just looked at a moment ago. What's the other one that should be looking at? Can't remember it. In the same area. Well, let's just do these two. So Under Armour right now at 95.19. What was the question? Where was the question? Was that Mike? No. I did. I can't remember if I went. Yes, I did. I went over the IWM, Mike, and J&J asked about UA, and is it the same type of setup as Nike for a short? You know, I would say that this has already shown the symptoms: lower lows, lower highs, lower lows, lower highs, and I would put UA in the category, and I'd probably say that a 95 or a 92.5 put, December put, is probably an easier way to go than shorting. And you know you've got your defined risk, etc. But yes, I would say that the way I'm looking at it, I think that if I'd put a stop. In fact, if I was going to do it, I'd start off with a small position, and the small position, because it's at 95, I'd allow it all the way to this candle, right? Just for 2 days, I'd have 100.67 stop. No, it's 5. I don't do 5 points. All right, let's do it this way. 96 would be your stop, just a 1.5. Why? Because if this move down in the 120-minute chart continues, it needs to get by Monday, this time Monday, just remind me someone, it should be under 94.20. It should be a point lower, and if it's a point lower, that would say, great, now you can look at it as if you possibly could add another position, that we talk about that if it does, I'll talk about Monday. So yes, this is risk reward. I'd say that Under Armour right now, fantastic company, but the chart does look like it's getting very tight and needs to rest, and it needs to test this really strong candle of the 28th of August, and that goes down to 92.52. That would be my candle, and the only way you know you're going to even approach that is if within Wednesday of next week it is it closes under 92 and still shows weakness, because then the target of 88.01, the low of last week, becomes a factor. And you're totally wrong if it bounces to 98. You're maybe not wrong, but you're a little bit early. I'll be right back. Basil Chapman, Tiger Technicians Hour.
Until recently, it was almost impossible for the average investor to hedge against currency risk in Europe or Japan. For a bold trade on Europe or Japan that protects against moves in currency, trade HEGE or HEGJ, 2 times currency hedged leveraged ETFs from Direction Investments. Visit directioninvestments.com today. An investor should consider the investment objectives, risks, charges, and expenses of the Direction shares carefully before investing. The prospectus and summary prospectus contain this and other information about Direction shares. To obtain a prospectus or summary prospectus, please contact Direction Shares at 866-476-7523. The prospectus or summary prospectus should be read carefully before investing. An investment in the funds is subject to risk, including the possible loss of principal. The funds are designed to be utilized only by sophisticated investors such as traders and active investors. Distributor Foreside Fund Services, LLC.
Hi, I'm Steve Rhodes, host of the Trader's Edge, heard daily at TFNN.com and author of Mastering Probability, a daily investment and trading newsletter service that I send out each morning by 8 a.m. My morning newsletter service covers exactly what the markets have been doing since last night's close, providing you with an edge on your trading day ahead. You get actionable trading ideas, including the exact entry, stop, and profit targets. Plus, I'll teach you the patterns and hidden market correlations that will make you a better trader. As a subscriber, you'll gain access to my 90-minute money management workshop, where I'll teach you the secrets that'll save your assets. The bottom line, I've got your back, including a 30-day money-back guarantee. See for yourself the type of analysis I provide each trading day by signing up for Mastering Probability today. With nothing to lose, this is an offer you should not pass on. Mastering Probability can be found under Trading Newsletters on the front page of TFNN.com.
In quiet markets, investors search for new trading opportunities. We'd like to introduce you to a new product that provides opportunities even in flat markets. Nadex, the North American Derivatives Exchange, is a new and innovative Chicago-based exchange registered with the Commodity Futures Trading Commission, and unlike most other exchanges, Nadex allows you to trade directly through them with direct market access when using their trading platform. Nadex never charges a fee to use their platform, which even includes real-time charts and full customization capability. Nadex's unique short-term binary options allow traders and investors to capitalize on strategies even when the underlying markets are quiet. Nadex's innovation has allowed them to come up with a line of unique trading products that are unavailable anywhere else. See how it works at nadex.com. That's NADEX.com, or click on the Nadex banner on the front page of TFNN.com. Futures and options trading involves risk and may not be appropriate for all investors. The Art of Timing the Trade Charts has officially launched at TFNN. In collaboration with Tom O'Brien and using his best-selling book, The Art of Timing the Trade, Your Ultimate Trading Mastery System, David White has programmed an outstanding piece of software that will complement any trader's methodology. Using this first-of-its-kind software, The Art of Timing the Trade Charts allows you to scan for Fibonacci formation setups, including Gartley's, butterflies, ABCs, and much more. The Art of Timing the Trade Charts is designed to help you when scouring the market for stocks just beginning to form the trading patterns that many investors spend days, weeks, and even months searching to find. As part of our introductory pricing, we're offering licenses available at only $59 per month. We're so confident that you'll love this new outstanding piece of charting software that we'll even give you a 30-day unconditional money-back guarantee. Don't miss out on this incredible new piece of software. Lock in your low price today by ordering your copy at TFNN.com.
Learn about good health and fitness. Living a primal lifestyle with Nico and Paige. Next on TFNN.
I've just got a couple of emails right now. Question on XAL. XAL, of course, is the airline index. XAL. XAL has made a peak D, come back under the 200-period moving average. So 92.26 up 1. This is going to be very, very important for the IYR, for the the IYT, the iShares Transportation ETF. The weekly chart is holding very well. 90.65 to 89.20. That's key support. A close under that on a weekly basis says, arch formation. Be a little bit careful here because you have to rebuild strength to get the technicals to improve enough to push it to the 96 area. At this particular point, you've got your peak D, second peak D in the XAL trading at 92.25, up 99 cents. On the left is the daily, on the middle is the weekly, on the right is the monthly. Still looking pretty good monthly, and the 120-minute chart shows how important the 90.23 area is as 200-period exponential moving average support. I would suggest to you, I don't know whether you're long or short, you're just using it as an indicator, but with oil dropping this sharply, it's rebounded, but overall, I don't see why the XAL is down this low unless there are other reasons for it. Technically, I would have thought that the XAL right now would be closer to the 100 or 101 area instead of 92. That's 9 points higher. So something's not quite right. It's acting okay, but really not great. So I'll give you the parameters. The close under anywhere in this is anywhere between 89.70 to 89.50 support. A close below that on the daily says be careful. You could retest all the way to the 88s, and that's going to be key. On the upside, if next week there's a rally and a sudden spike occurs and it goes above 94.39, suddenly the 200 period smooth moving average, which most fund managers use at 95.92, becomes important. That will change the complexion of the character of the weekly chart. So those are your parameters. Into the 94.50s, very positive, close. A slide underneath 90.60 says, oh, start being a little bit cautious on the XAL. So the next question was HGX. So if we want the HGX, let's go to this one here. Here's the HGX index. This is the wood. This is the iShares Global Timber and Forestry ETF. Still holding okay, holding that the 200 period moving average support in the weekly chart. But it's telling us that something's not quite right in the housing sector. And the housing sector says, yeah, we made our peak. I should have typed that in at 252.20 the week of the 21st of August. Now we're pulling back. And until 235s is it, and it's at 230 right now, up 254, the housing sector index, unless it makes an arch formation, it'll only really do that if it really closes above. Gee, it has to go all the way to 240. I'm just saying 235s. I'm impressed that at least there's a counter trend rally. Right now, it's not that good. And if the HGX index closes at 222 next week for any reason, I'd say it's over for now in the housing. So this is a very important moment. So, okay, a couple of things that I wanted to do here just as we're wrapping up. Just quickly, the VIX index has been doing nothing. VIX.X. And the VIX index under the 9-period moving average, the weekly looks just very, very weak, is saying there's still buying pressure. Just keep it simple. At 1466, I would have thought it would be down in the 12s, but it's actually at 1466. It's a little higher than I thought. But at 1466 is saying there is still enough buying pressure to at least support the market overall. That is the key indices down in the S&P. But if it starts to trade back into the 15.5 to 16.5 area anytime next week, that's where we will see. Remember, I said to my subscribers this morning to my opening call, in a bear phase, you've got to see three things: a rising volatility index and falling stocks, and bad news. They have to keep coming one after the other, over and over and over to sustain a downward. Otherwise, the cork just floats up to the level that it wants in water. So this is what we're looking at. Very important few days coming up next week. Opening call, I have quite a few charts coming out Saturday and Sunday. Thanks for being.
Tom O'Brien's weekly gold letter, The Gold Report, gives complete and concise coverage of the entire gold market. Inside, you'll get Tom's commentary on gold, the dollar, the rand, the bond, the XAU, the HUI, and detailed coverage of nearly 25 mining stocks. He'll give you the entry price, price target, and stop price of each stock trade. The Gold Report is a long-term newsletter where the focus is on building real wealth through the management of a successful portfolio of gold stocks. With a lifetime of knowledge and almost 12 years of writing his informative weekly newsletter, The Gold Report, Tom O'Brien can provide you with the important market information to help you make better trades in the gold market. Don't let the next bull run in gold pass you by. To get a month-long free trial to The Gold Report, an $85 value, visit the front page of TFNN.com today.
This is TFNN,